Okay, good morning, everyone. Welcome to Macro Ace with your host, Tony. Hopefully, you guys can all hear me nice and clearly, and hopefully the sound is coming through all right. All right, so we have not too much to cover with CPI today. Hopefully, we've got a load of people on here who are live with us. Thank you very much for joining us. So let's go through the US CPI data, inflation, which is very important for the Federal Reserve and also markets, whether or not they're going to be pricing in a 75 basis point hike or a 50 basis point hike for the meeting that's going to be coming up pretty soon in September. So let's go through what CPI is first of all, go through the fundamentals then. So what is CPI if we don't know it already? So it measures how much consumers are paying for retail goods and services. So you have the month-on-month change and the yearly change as well. So the reason why it's such an important economic release and why it's considered a very important release to look at is because of how it's measured. So you have 26,000 retail outlets, 4,000 housing units, and in 87 urban areas that are measured. And so prices are collected on 80,000 different goods and services overall within the US in those urban areas. So you would have, your agent going out to the store, looking at the price changes, and then making their estimates on whether or not data has been, is much better than, if prices are going up or if they're going slightly down. And then that will, of course, feed into the final report for the month-to-month data and also the CPI data from the Bureau of Labor Statistics. So the key measurements then for the CPI report itself, key things we need to know, what it covers or why it's so strong, is that housing represents about 42% of the CPI report, and food and beverages about 14%, transportation about 18%, medical care about 8.5%. And then the core CPI excludes food and energy. So, of course, that gives you a much better understanding of, how strong is inflation at the moment in the US. But for traders, the key thing is what is inflation doing overall in every area of the economy, including energy and food. Of course, those two bits, food and energy, have been the key big drivers in the CPI report. And that's why we've seen these big old numbers coming through, setting fresh 40-year highs with the CPI data that we've seen. So markets have been, they've sometimes been surprised when the expectation is for CPI to go down, but it doesn't go down. And then sometimes analysts and economists, they expect CPI to come in slightly higher than the previous, but then it flies out the window and says, hey, no, actually, we're going to go, CPI is going to be even hotter than we expect. So like the last time we had 9.1% inflation compared to the, of course, the prior of 8.6%. So, we really flew off and we went really, really high with that. And the markets were expecting 75 basis points hike. So the seasonally adjusted data is the preferred measure so it's the preferred measure, and that feeds into the month-to-month data. Again, it's seasonally adjusted. All it means is that what's going on in the economy without the effects of weather, production cycles, etc. If there's expected to be a lot of spending, let's say for ice cream, as an example, because of course it's summer, it's really, really hot. Maybe there's an expectation for there's more spending for maybe chicken and for meat or certain types of meat for barbecue, and so the CPI it might just adjust some of those bits of data that are expected to be really, really strong, but during certain time periods or seasonal time periods. So that's why the seasonally adjusted is the preferred measure, and it's the headline data that we get from the BLS, from the report. Then if we keep going on then, so the difference between PCE and CPI, this is quite key to understand if you're trading inflation data within the US session. So the PCE inflation places a lower weight on prices of gasoline and of residential rents, or your housing basically, which have sent CPI skyrocketing in the past. Okay, so also the other key thing with the PC and the CPI price index is that the PC price index measures data across the country altogether, rather than just focusing on the urban areas or the cities and towns like the CPI report does. So you get a broader measure of inflation where it is at the moment. And so that's why sometimes you see a bit of a difference between, you usually see a difference between the PC price index and the CPI price index. And that's why it's a preferred measure of the Federal Reserve too, looking at, when they make their forward guidance of where they're expecting CPI to head in a certain direction. That's what they use as their forecasting tool. But, CPI, of course, is very important as well, because that, in the past has led to the Federal Reserve taking stronger rate increases, stronger monetary policy action to try and rein in inflation as much as they can. So that's the key difference. PC price index also doesn't measure a fixed basket of goods, whereas CPI does. So the PC price index is more malleable as to what it can measure. So for example, if beef prices are really expensive, but people are actually buying chicken, then the PC price index will look at, might decide to look at chicken prices instead, compared to CPI, which will just say, okay, beef prices are going high, so we'll pop that into the BLS report for the prior month. Then moving on to how does it affect the market? So key fundamentals of how it affects the markets in a normal trading environment, where you don't have central bank tightening or central bank easing. So the dollar tends to strengthen when the economy is growing and when inflation grows. Of course, that leads to the expectation for the Federal Reserve to maybe start raising interest rates or continue raising interest rates. And if we look at stocks, so the key for stocks as well, in a normal trading environment, is looking at the underlying inflation data as well. So the core CPI data. So if that rises sharply within a month, then that can lead to stocks taking a hit. But in this current environment, any sort of indication that inflation is higher than expected or higher than the forecast, that will lead, and we've seen in the past, to devaluation or bearish reaction from the stock market. And the stock indexes, boom, they take a massive punch to the face when you see CPI data surprised towards the upside. And we'll look at the deviations to kind of course, prove what had happened in the past. And then for bonds, high inflation readings, when we're looking at yields, not the bond price. So the bond yields with a higher inflation reading leads to high yields and in an expansionary environment. And because, of course, the central bank, the central bank has a lot of control in the short-term rates or the short-term bonds within the bond market, okay? And then the long-term bonds kind of just follow suit to a degree. When inflation ticks higher, the expectation for rate hikes or stronger rate hikes also increases as well. And that leads to bond yields, soaring much higher. But on the flip side, for bond prices, of course, if you have a high yield, bond prices will go down. Okay, so remember, there's a lot of demand and supply that's got to be matched. And the government, with higher rates of interest, they're not going to, usually they wouldn't set, they wouldn't give you a low price for a high yield. They'll give you, what they would do is that if there is a high yield, they will try to increase, if there is a lower yield, or if bonds are giving you a lower yield, they would increase the prices. So of course, they're not going to pay out a bunch of money for a high yield of return. But the key thing is, a better than expected CPI print will lead to higher yields and lower bond prices. Then the previous report. So if I just bring up on here, just the screen. So looking at the previous report then from the BLS, or the Bureau of Labor Statistics, for the data that we had in July representing the month of June, the key thing is that so there was increase, was broad-based in gasoline, shelter, and food being the largest contributors as well. The energy index rose about 7.5% month on month and contributed to nearly half of the all items increase, with gasoline rising 11.2% and other major components index also rising as well. So the key thing is that inflation is still quite strong, but with the energy index overall for the month-on-month reading it's showing that it wasn't as strong overall compared to the prior reports, where energy has been the biggest mover overall. Does everyone kind of understand what I'm talking about so far? Just about, the economic release. Hopefully, if you're not sure, I can kind of go through it maybe after the release. But that's the key thing, is that energy prices, the energy index overall didn't take the lead when we'd seen the previous report for the CPI. So that could mean we could see a slight tick down in CPI. But again, we have seen surprises in the past where markets and economists were expecting CPI to go down, and then it flies towards the upside instead. So other things also to look out for as well. So we'd also seen, if we're looking for a 12-month period, so of course we had seen 9.1% print, and all items excluding food and energy rose about 5.9% over the past 12 months or past year. The energy index rose 41.6% over the last year, which was the largest 12-month increase or since the period ending in April 1980. The food index on the 12th in the yearly report was 10.4%. Again, the largest monthly increase in the period ending February 1981. So these 40-year records being, broken again, and we're ticking higher in the yearly data. The month-on-month data showing a different picture, or slightly different picture, albeit with energy just being not the strongest part of the report of the CPI data. So that was the previous report that we had seen from the BLS. So food, shelter, and gasoline being the biggest contributors to the month-on-month. And then for the year-on-year, it was still energy and food being the biggest contributors as well. Now, if we look at the where the economy is at the moment, so of course we had a stellar non-farm payroll read that we had, last week. Non-farm payrolls data. So non-farm payrolls came in at 528k, and versus the prior of 372k. So that smashed not only the previous figure, but also the forecast too. There was about a 300k deviation with the non-farm payrolls figure, and that had caused the S&P to dip, the dollar to fly, gold to dip as well. That had smashed estimates, and also the unemployment rate had finally ticked down to 3.5% to pre-pandemic levels. Okay, that's what it took. Probably a good 4-5 months or so, or about 4 months for the CPI, for the unemployment rate to actually tick down to 3.5%. Average earnings came in at 5.2%. So also compared to the prior, the original prior was 5.1%, but the revision showed 5.2%. But still, the forecast was better than forecasted. Forecast was about 4.9%. So average, so wage prices, okay, is the key thing as the key measure of inflation, right? If wage prices are also increasing, then that means that people are actually able to spend more money on the same amount of goods that are produced within the economy. You had employment costs. It also ticked down by 0.1% to 1.3%. PC price index year on year ticked to 6.8% versus a prior of 6.3%. Core PC price index was at 4.8% versus a prior of 4.7%. ISM manufacturing prices paid, of course, how is the manufacturing sector doing? That had also seen a decrease to 60 from a prior of 78.5. And non-farm productivity quarter on quarter at 1.4% versus that was the February data. So, of course, the new data that we had. So, of course, the new data that we had for US productivity prelim was at minus 4.6% versus a prior of minus 7.3%. And if we're looking at other areas too, so import prices has seen a slight move towards the downside of 0.2% versus price spot 6. Export prices also down spot 7% versus prior to spot 8%. PPI year on year also was higher, or slightly, or was higher by 0.5%, 11.3% versus a prior of 10.8%. So these key measures of inflation showing a mixed picture, basically, of price pressures. So of course, non-farm payrolls, if there are more people that have, if there are more jobs that are available and there are more people being pulled back from the labor force into those jobs, they have the opportunity to actually spend some money or spend more money if they're getting another job as well on top of the job that they currently have. And if the unemployment rate is also ticking down, then that also bodes well for the US economy. So there's this talk of some of the key things as well. We'll look at if there are what the recession fears, but let's go through the triggers then for the economic release. So the month with a high estimate of spot 4%, with a low of 0%. So of course the median estimate that we have today from the economists, they're expecting spot 2%. So that's a 0.2 deviation on the month, and also on the high end and the low end. For the year on year, they're expecting a high estimate of 9%. So of course, the median estimate is 8.7%. So they're looking for about 0.3 deviation on the upside, and about 0.2 deviation on the low end of with 8.5%. Also, other areas to also keep in mind as well. So core month on month with a high estimate of spot 7% with a low of spot 3%. A core year on year with a forecast of with a high estimate of 6.2% with a low of 4.9%. So of course, for the core CPI year on year, median estimate is 6.1%. So looking for about 0.1 deviation on the high end there, and then also for the month on month, looking for about 0.2 deviation with a median estimate of spot 5%. And they'll look for a 0.2 deviation either way. So those are the triggers then. So if we're looking at the deviations, what I want to show you as to why higher inflation readings aren't good for the stock indexes and is bullish for the dollar. Historically, we've seen that when data has been better than expected, that we've seen a negative reaction from the stock indexes. So on July 13th, we had seen from the S&P 500 in the first candle going all the way to the going to the top, going to the bottom of the wick, or going to the wick, or going to the end of the wick. We've seen about 299 ticks down, and then after about 10 minutes of trading, that's what the bracket represents. It was down about 391 ticks. The Nasdaq had a ball of a day. It was horrendous. We'd seen about 1,400 ticks down after the data, and after about 10 minutes of trading, it was down by 1,638. So then the Dow Jones had also seen tick down 420 ticks down. Somebody said it doesn't come out for another 40 minutes. I know, this is just when the live stream starts, just so you don't, just to let you know. Yes, we've got about 11 minutes now till we get the data for the release. So then the biggest mover currency-wise, what we'd seen was if we look at it here, so we'd seen that the Aussie dollar, US dollar, seen the biggest move down initially. And then for the dollar CAD, of course, we had a different bit of data there. So dollar CAD, we'd seen it was about 60.8 pips towards the upside. Actually, that was the largest mover there, and then there was the second largest mover for the Aussie dollar. Dollar yen had seen about 49.5 pips up, and after about 10 minutes of trading, it was about 56 pips up. If we're looking at the bond market, or for gold, before we go to the bond market, so gold has seen about 95 ticks down, and after about 10 minutes of trading, is down by about 189 ticks. For the bonds, we'd seen that the 2-year, remember the shorter term bonds have seen the biggest reaction from the markets compared to the longer term bonds. Of course, as I said, the central bank has the most control in the short term bond market, and the long term bonds are traded by traders and investors. But we'd seen 65 ticks down on the 2-year bond, and after about 10 minutes of trading is down by about 60 ticks. 30-year bond was down by about 39 ticks, and after about 10 minutes of trading, it was down by about 42 ticks. So the key thing being is that you're expecting, if you do get better than expected data from the US for the CPI data, then you're expecting, and then what we'd seen from the past, you'd see a negative reaction from the stock indexes and a positive reaction from the dollar overall in the market. Now, when data has been in line with expectation, this is the key thing. Okay, whether data has been in line with expectation or lower than expected. So you can see here back on March 10th, and when data was in line with expectation, you'd actually seen the reversal happening instead. The reverse. You'd seen stock indexes see an appreciation, and you'd seen the dollar see a depreciation instead. So when data was, when data was worse than expected, okay, then we had seen a bigger reaction from the market. So when data is in line with expectation, we'd seen positive reaction from the stock index and a negative reaction from the dollar. And when data was worse than expected or lower than forecast, we'd seen an even bigger reaction towards the upside for the stock indexes, or bullish reaction, whereas for the dollar, we'd seen a bigger reaction towards the downside. So you can see there, there's about 31.7 pips towards the downside off of the data there. So if we keep going along as well, if we keep going down, what we can see overall, but yeah, so that should kind of clear up things. Hopefully you guys understood that. But key thing again, better than expected data, not good for stock indexes and not good for gold. Better for the dollar. And if we get in line with expectation, not good for the dollar, better for the stocks, and worse than expected data or lower than expected data, even better for stock indexes, and worse for the dollar. So that's the key thing. I think for the reason why we're experiencing that is because everyone's kind of focused on what inflation does, right? And the central bank as well had taken that action for a 75 base point hike when inflation was much higher than expected. So this is what we need to understand, is that inflation is a very, very key release that we need to be aware of. Okay, so the sentiment then. So I was talking about people having recession fears. I think the key thing is that what causes a recession? So, of course, you had Fed's Powell and other Fed members that said that that if you have two negative prints of GDP, that's what causes a recession. But in actuality, what we've got to look at is non-farm payrolls, or jobs being added to the economy, the manufacturing sector, the sentiment from consumers, what they're expecting for the future, and also for inflation too, and also for the unemployment rate data as well, and housing data. So non-farm payrolls was much better than expected. ISM and non-manufacturing data were much better than expected. And the UMich survey, the University of Michigan sentiment of consumers, was also much better than expected as well. So those who are calling out saying there's a recession, well, other bits of data, if you're just looking at GDP data, then you can say, yeah, there is a recession. But remember, that data is delayed and it's old, needs being compiled all together, right? These economic releases that we have here are recent bits of data that will, show where the economy is at the current moment, right? Gives you a fresh idea of where the economy is. And that's not showing that at the moment. But that's the current thing about the markets, is that they're fearing that there could be a recession. Also, with the mixed earnings that we had from the reports from stocks as well, that also there were some fears that you maybe have the big tech companies like Microsoft, who recently said they wanted their team leaders to cut down on their spending on unnecessary areas. You also had, of course, other areas too. So Google wanting to kind of slow down hiring. Tesla, who said Tesla, they had wanted to slow down hiring too, or pause hiring for Microsoft. Actually, was it was Google that wanted to pause hiring for a couple of weeks as well. So that's the key thing, is that recession fears, how earnings are going to be affected. If there's a mixed earnings report, that's also another thing to be aware of. That's also had an effect on sentiment too. And also the New York Fed survey too for inflation, right? What is the inflation expectation? This is also quite key for today's release data as well. We've got about 5 minutes left. So the median 1-year inflation outlook among US consumers fell to about 6.2% in July from 6.8% in June, while the 3-year fell to 3.2% from 3.6%. So consumers are expecting inflation to tick down within a year, but it's not going to be an instant reaction. We didn't see a reaction from the markets of the New York Fed survey data, and usually consumer sentiment is very, very key for expectations of where inflation is going to be headed and what the central bank might do as well. But again, we haven't seen those figures yet, and we haven't seen a continuous drop off in inflation data, or a sustained move towards the downside in CPI data. So that's I guess that's also another thing to be aware of as well, sentiment wise, from consumers' point of view, that are expecting inflation to tick down. Of course, that's with the higher rate hikes or stronger rate hikes that will cut off or slow down or dampen spending or borrowing that consumers do for credit, and also businesses as well, when they're taking out a loan as well, or when they're paying back a loan, they realize, we keep borrowing more, we're gonna have to pay more money back to the commercial bank, or that we've borrowed money from. So that's also reason as to why the inflation outlook had seen a drop off in this month's report, or in this month's report representing July, compared to the other reports where they were expecting inflation to be higher than expected. If we're looking at the Fed view, then I'll be quick with this. The Fed's daily saying that 50 base point increase is definitely in play. We need to keep an open mind. Bowman saying a 75 increase is possible until inflation eases, and they said that I find a few, if any, signs that inflation has peaked. Fed's Messer says I need to see several months for falling inflation. Kashkari saying it will most likely take several years to return to 2% inflation. I kind of go through. I want to get through the other stuff too. So if we go through some of the investment bank views, so Citi estimating 8.8% for inflation, Goldman Sachs 8.8%. You have Scotiabank looking at 8.9%, which is higher than the forecast. Morgan Stanley is the only one that is expecting a lower figure compared to the forecast of 8.6%. The forecast is 8.7% for the year on year. Month on month, well, more or less expecting inflation to be at around 2%, with Scotiabank being the outlier of looking at 4%. Then previous market reaction, we've got about 2 minutes, so I'll quickly play it here. So even before the markets had time to actually receive the data, you'd seen that the markets were trying to trade the release, and then boom, right? CPI year on year, also month on month, year on year, and data comes in much higher than expected, and that blows out everyone else. So you'd seen the S&P go down, gold take a hit too, and the dollar see an appreciation. Keep going high, keep going across. What we can also see is that there was a continuation. So even on the bond prices there too, on the 2-year, we'd seen that move towards the downside. We've got about 47 seconds left. Okay, so if I just exit this video, get this out of the way. Okay, get my tick strike going. Okay. All right, we've got about less than 30 seconds left now till the release. All right, so I've got my S&P, got the dollar yen, I've got gold going. Also need to get, we've got about 10 seconds left now. Right, let's see what this baby does. So market's already trying to move beforehand. We haven't even got the data yet. Okay, come on. 0%, that's lower than the forecast of 0.2%. CPI year on year 8.5%, lower than the forecast of 8.7%. Core CPI year on year 5.9%, 5.9% lower than the forecast of 6.1%. Core CPI month on month, spot 3%, lower than the forecast of spot 5%. So data worse than expected. You can see as expected with a worse inflation reading that you've seen S&P go higher, the dollar taking a hit there, gold flying here as well. If we also look at if I grab up the 2-year note as well, you'd see, let's bring that up here. There we go. All right, bond prices also, 2-year bond prices going higher. So there we go. So data much lower than expected overall, and seeing this very negative reaction from the dollar, positive reaction from the S&P 500. What I want to do is also look at the CME FedWatch tool as well, see if the markets are looking for a 50 basis point hike rather than 75 basis point hike. Let's have a look here. Okay, so let me just bring this up for you guys. So give it a refresh. Just want to see. I know I literally just clicked on it. All right, so at the moment, what can we see? We can see about 64%, 64.5% expectation for a 50 base, for a 75 basis point hike, and 35.5% chance of a 50. I want to see if the thing is, I don't think that's fresh or that's completely new or altogether. What happened to my tick strike? I just flew off. There we go. Let's have a look. Not seeing any changes on the CME FedWatch tool as of yet, but again, that's one bit of data. Again, so we've had, that's twice now that's happened, where we've had a decline, and then the month following we'd seen an increase instead. So, but overall, worse than expected or lower than expected data led to these dollars decline. Let's have a look. Let's do some measurements here, shall we? All right, let's see. So dollar yen. Okay, so it was about 182.5 pips down on the dollar yen. S&P 500. Let's see what you did. But yeah, this is kind of the like the jarring thing is, like, sometimes the markets will try and move beforehand when the data hasn't even come out yet. We go to the top of that wick there, so we'd seen about 216 ticks towards the upside in the S&P. Let's look at gold. Gold also loved it too. Kind of threw me off. It looked like these. It's like, so move. Right. So gold. Let's see how many ticks we got from that. It's about 161 ticks. 2-year bond prices. Okay, go to the top of the wick. Go to the end of the week there. It's about 93 ticks up. So yeah, that data. Somebody said, I'm scared. A real idiot said, I'm scared. Rigged. They rigged the data. Trevor Mead says, you in puts, bro? Ouch. Let's see, what else could we get? Let's see. Kieran Chandler saying, there go the indices. I told you the market would move. Rural Idiot said, what's your guess in chat? There's just a lot of comments that you guys have said. Actually, I want to bring up some of the other areas too. Let's look at the let's look at the NQ as well. See what happened there. That would definitely have, if we had seen about 62 ticks towards the upside, or about 216 ticks towards the upside on the S&P, that would see a huge monster move on the NQ tick wise. So let's have a little look. All the way to the wick. 924 ticks up. Holy moly. Let's look at the YM. Let's had a ball of a day as well. Okay, so there we go. That's the headline there. If you can just see it on the FinancialJuice newsfeed. So, okay, so the YMC has seen about 289 ticks up. So, Fed seen raising interest rates by 50 basis points in September based on Fed funds future pricing versus 75 basis point hike seen before the CPI report. So, that's the key thing that I was looking out for, right? Whether or not markets would price in a 50 basis point hike rather than a 75. I'm still not seeing an update here on the CME FedWatch tool yet. Still the same somehow. Alrighty. What else have we got? Right. Also, so from the FedWatch tool, odds that Federal Reserve will hike by 75 basis points in September drop sharply to 32% from 68% before the CPI data. That's from the FedWatch tool. Don't know why it's not updating on this image I'm trying to look at here. Anyways, all you got to know is that data was lower than expected, and you're seeing traders now looking for a 50 basis point hike rather than a 75. Remember the very beginning of the week. What we had seen is that we had actually on the weekend we had seen Fed's daily saying that a 50 basis point hike could be in play for the September meeting, or they definitely, it's definitely something that is in play for the meeting. Let's look at crude. Somebody's asking for crude. Of course, if the dollar goes down, you've got to think that the crude will go up. So about 65 ticks towards the upside there, or about 65 cents there on crude oil. But yeah, so remember on the weekend we had on Sunday I put out the headline, and this is also I put in the weekend wrap into the macro race prep for you guys to have a look at. Is that we had Fed's daily said that 50 basis point is definitely in play, and that had caused, if you were wondering why the markets were going up at the beginning of the week, other than just the technicals, right, or just the beginning of the week. That was the main reason why. So a lot of traders were looking for a 75 basis point hike after Friday's non-farm payrolls data, but the CPI report, right? But Fed's daily said that we could see a 50, at the next meeting. And that's why the stock indexes had seen a rise at the beginning of the week, and now this data that we've seen here. It's going to be a bit more difficult now, because I think the key thing is the Federal Reserve is focusing on inflation, right? That's their key mandate at the moment. But don't forget, jobs is also one of their part of the mandate too, for maximum employment, low inflation, or inflation at the 2% goal. Remember, those are the two mandates that they have. CPI being now the stronger mandate or the stronger focus for the Federal Reserve. So this could lead. I'm not going to, just off the CPI data, 1 month bit of data, we've seen lower than expected data. If I kind of go back to my CPI report, then I think what would be very beneficial is to look at some of the other Fed views too, which I kind of didn't get to look at. Moving up here. So we had Fed's Powell on July 27th, who had said that although prices for some commodities have eased, there is still additional upward pressure on inflation. Another exceptionally high rate hike may be appropriate depending on data. So remember, when they said exceptionally high rate hike, they've usually talked about a 75 basis point hike. So now that we've seen inflation kind of tick down for 1 month, right? We've got to wait for other bits of data too. Powell did say on the 27th of July that they would monitor both CPI and PC price index data, but they believe the PC is a better measure of inflation. But that's something that kind of, what I had already said before, kind of hopefully that kind of made you understand that CPI is the most important report for them, for the short-term trends or short-term reactions to the Fed, whether taking a rate hike or a big rate hike or slightly smaller rate hike. Other areas too. So I want to look at the Aussie dollar because that had a nice big move last time compared to some of the other currency pairs. If we look at it here, let's have a look. So also, if you can see on the screen at the same time, I'm looking at Tick Strike 2. So Tick Strike, it just allows you to listen to order flow, right, of what's going on in the markets, or the momentum of how much momentum that there is of buying or selling within a certain asset, whether it be a currency, a pair, or stocks, ETFs, ETNs, crypto as well, and also looking at the internals, so like the VIX and also the ADD. Those are also shown on Tick Strike as well. So actually, if I bring up the window here. So this is the Tick Strike window. So again, as I said, you've got Forex, you've got your crypto, your futures, you've got your stocks, ETFs and ETNs, internals. They have all there. We're adding a load more to stocks, by the way. So we're continually adding to this. You can see you've got a load of a range of different stocks we can look at. You can look at as well. Of course, the big boys, Apple. You've got Google there as well that are there, Amazon, the likes of those guys. Actually, let me put on Apple. Let's see what Apple is doing. Probably isn't going to do anything pre-market, so we're probably not going to see anything coming through from there. Cryptos, see what Bitcoin is doing. Of course, if the dollar is down, you'd expect crypto to go higher. Okay, nothing going on there at the moment. All right. Okay, so let's also have a look here. So, of course, remember with the stocks, the market opens, and of course, you see that ticker going off Apple. But yeah, so that's the overall market there. So that's the Aussie dollar. Let's look at cable too. So what we want to do is provide you guys with a 7-day free trial of Tick Strike. Okay, so let me just put in this link in the chat for you to have a little play with. So if you're unfamiliar with Tick Strike, other thing to be aware of is that with Tick Strike, so you've got all these numbers going off here, right? So this level 1 being the most sensitive to the markets. You've seen, so the reason why level 1 is the most sensitive is if you do see any like little bits of movements going up or down, as we can kind of see here. If I look at the dollar yen, we can see a little bit of selling going on, and Tick Strike is going off of here. So 1 being the most sensitive to the market reactions or the market movements, level 15. So if you increase that number to level 15, that's the least sensitive to the market reactions. So only when there's a big amount of momentum, buying or selling, a momentum that's going on within the markets, then only then would you see Tick Strike going off with your number and your color, and also the sound as well. At the moment, I don't have the sound turned on, otherwise you'll just hear it constantly going off at the moment. But that's something you can kind of adjust and have a little play with in the full version that I've just put in the link for you in the 7-day free trial. So a lot of traders, scalping, managing their risk, or capitalizing on potential trades. That's what people use Tick Strike for. But again, use it however you want to use it. Kind of see what suits your kind of trading method or trading style, and then kind of incorporate that however you want to incorporate it. If we're also looking, okay, there we go. Some reaction from Bitcoin now. All right. So other than that, so also FinancialJuice, right, where we can also see here. Oh, we got some more data coming through. Money market still nearly priced for probability of 50 basis point ECB rate hike in September. The reduced bets on ECB rate hike price in 105 basis points of hikes by December versus 113 before the US CPI data. So CPI data is having a big effect on everyone else as well. So what else have we got? So yes, of course, this area that you have FinancialJuice Pro, right? Let me just close Tick Strike down for a moment. There's a big screen for you here. So FinancialJuice Pro, right, where you can get the market reactions of the economic releases that we've seen here, the headlines of what central bankers are saying or markets are expecting, the data as well for the economic releases. That's all on here on one page with the live voice and text feed that we have here, right? We also have the need to know market risk. So if there's anything that traders need to be aware of what to kind of what are the key risks? What is the key risk that the markets are expecting or have seen already from the past 8 hours or so within the trading session? So that's the key thing that we also have there as well, the need to know market risk, which is continually updated depending on, of course, what the headlines that are coming through. But also, as said, you have your economic releases here on the left-hand side, which is also in real time as well. So key thing is with the FinancialJuice Pro, and I'll put in the chat feed here for you, and I'll pin it for you as well. Let's pin it. There we go. That's pinned in the chat. So FinancialJuice Pro, you get no delays, no adverts playing. Okay. Also, the economic releases here, you can also set triggers as well for your buy and sell alerts, whatever you want to do. Ignore this number here. This is just showing the forecast figure, but your buy, you can either buy or sell if the actual is greater or such and such. You can kind of put that to whatever you want it to be. Once you've saved it, then it'll come with up with a little red, or depending on what the color of the release is, it'll come up with a little filled in button for this timer thing here. When the release comes out with the figures, if it matches your trigger, then it will either show you a buy or sell sign depending on what you had put up on there as well. So that is there for you as well. That's also real time, whereas it'll be delayed on the live version. So that's the 7-day free trial that you can get of FinancialJuice Pro that I've also pinned to the chat as well. Of course, if you liked the stuff that I've done today, right? If you found it useful, then don't forget to follow us on Twitter as well, Macro Race on our Twitter. And then also, there's still a lot more to go through. We also have the Macro Race mailing list as well. So if you wanted to look at the deviations in more time, so this is what I kind of show, I'll put it together like a PDF. So the deviations for the economic releases, not only the CPI report, but for whichever release we're going to be covering for the week, then I kind of put it together as a PDF, and you kind of have a look at the other economic releases that I do here as well. So there you go. That was non-farm payrolls last week. There you go. There's about a 300k deviation. Just as a fun fact, a 300k deviation used to be our deviation to kind of expect a strong reaction from the non-farm payrolls release. In the past, we had, for this release, we had about 100k deviation that we were looking for, but this kind of blew it out, blew all the data out of the water. So again, here, deviations of showing you the difference between the actual and the forecast, how that's affected, or how much that's affected the markets. That's also in Macro Race. I also provide the week ahead of what to expect in the different sessions, so in Asia, Europe, US, and the headlines that have come out on the weekend, or the summary of the weekend news, and also the releases that we'll be covering as well. And that's all in one email that I that I provide for you guys. But so that's FinancialJuice. Keep an eye on the markets. See what we're doing here. S&P, NQ, YM, crude still going higher. Dollar not having a good day. So let's see. It's probably been about 10 minutes or so. So right. So yeah, after about 10 minutes of trading, it's down about 196 pips. But yeah, so that's Macro Race. That again, you can sign up to that mailing list for you there. And then finally, if you love stock trading, and if you like trading unusual volume activity in stocks, so you can join our free beta test group of a new service. That's here. I'll put in the link for you in the chat as well. Oh, sorry, somebody's got some questions. There's a lot of questions here. Active Hamelda, let's see what you got here. do we have an updated currency strength meter, and interest rate probability tracker inside FinancialJuice Pro version? No, we do not have that there. One thing we do put out in the mornings is the currency strength chart in the European session, which covers. Saying why don't you answer my questions, dude? Hold on. Don't worry, relax. You got me for a bit of time. Yeah, so we usually put out like a currency strength chart for you here, which in the morning, so that's in the European session. At the moment, what we can see is, if we had a look here, so that's what we can see at the moment for the currency strength chart. That's not something that's like a real-time thing on FinancialJuice, but if you want to kind of have a look at it there, then that's kind of it for you there. So the dollar being the weakest currency at the moment there. Wow, that fell off. But yeah, that's something we put out in the morning in the European session for you guys at around 3 a.m. Eastern time. But if you want a more up-to-date one in the US session, then we can definitely do that and add that for you guys as well. So again, so key thing is, any sort of questions that you have, anything you want to kind of improve with the service, do let me know. Not only MacroAce, but also FinancialJuice too. So you can also email me at tony@financialjuice.com, and then you can let me know here for any sort of improvements that you want within the service. All right. So that is it. Thank you very much for joining me. That's also it for MacroAce for the week as well. And I will see you guys next time. Thank you very much.